Is Palo Alto Networks a buy or a sell? Let's get started with the model. This is a large cap company, 128 billion market cap. They're trading at $3.89 a share, and they have 328 million shares outstanding. Palo Alto is a cybersecurity company with over 80,000 enterprise customers. Started in 2005, headquartered in Santa Clara, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. A really nice growth of free cash flow from 1.8 billion to 3.1 billion. It came down a little in trailing 12 months to a little under 3.1 billion. Amazing margins. They convert 33 to 39% of their revenue into free cash flow. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that was negative in 2022, a little under $500 million in 2023. It blew up to 2.6 billion in 2024, up nearly 500%, up to 2.7 billion in the trailing 12 months. Margins have gotten really good, 33% in the trailing 12 months. Revenue is a sales for the company, and that goes up nicely each year from 5.5 billion to 8.3 billion. So their financials look solid. We estimated 4 years of future free cash flows. We also estimated a terminal value. It's all cash flows. Past year 4, that's 107 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $94 billion. We divide that by 328 million shares. And we get a calculated stock price at $285. They're trading at $389, so they're trading at a 36% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 105 companies in the same industry as PANW, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx since they're a software company, 164 million. A good debt to equity ratio, 0.2. For every dollar of equity, they have 20 cents of debt. They don't pay a dividend. They generate a lot of free cash flow, 3.1 billion. They rank 4th in market cap. If you double their market cap, it's pretty close to Adobe. If you double Adobe, it's pretty close to Oracle. And if you double Oracle, it's not even close to Microsoft. They do look overvalued according to their price multiples, trading at 47 times earnings, 42 times free cash flow. They do generate a lot of revenue, 8.3 billion, but a lot less than the top 3, not just a nominal value, but as a percent of their market cap, because their price sales is a lot worse than the top 3. And the stock price is $389, which is about 4% below their 52-week high. 48% above its 52-week low. And their 50-day moving average is well above their 200-day moving average, which implies the last 50 days they're trading at a much higher level than they were the past 200 days. If you put $10,000 into this company 10 years ago, you'd be really happy at $104,000 today. That's a 939% total return, a 26% annual return. So to summarize, I have them trading at a 36% premium. I give them a ranking of 6 out of 10. It's a good company, appears a little overvalued, so I probably wouldn't buy it short term, 6 out of 10. Long term, I would definitely buy it. I think it's a great company, 8 out of 10. Really weak ratios, they appear overvalued, 2 out of 10, but great financials. They're growing a lot, their free cash flow and their revenue, so I give it 7 out of 10. Let's look at their latest 10Q. We'll start with the income statement. The 3 months ending 10/31/2023 and the 3 months ending 10/31/2024. Revenue is up a little bit from 1.9 billion to 2.1 billion. They have product revenue and subscriptions. Both are up. Let's see if they give a different breakdown of the revenue. Of the 2.1 billion of revenue, 1.3 billion in the US, 100 million South America, 440 million EMEA, 255 million APAC. It's up in every single location. They do break down subscription and support revenue, 1.2 billion subscriptions, 590 million support. Both are up from last year. Let's look at this income statement. It has percentages. 16% of their revenue is product, 83% subscription and support. So for product revenue, expenses 75 million. That's based off of 350 million of revenue. So really good margins. Subscription and support, 1.8 billion of revenue, a little under $500 million of expenses. Fairly good margins. Cost of revenue, 550 million, which is 26% of their revenue. So gross profit, 74%. That means they convert 74% of their revenue into gross profit. Then you have operating expenses, 480 million R&D. That's 22% of their revenue. Sales and marketing, 720 million, 33%. It was higher last year, 35%. Then you have G&A 100 million. So total operating expenses 1.3 billion. Operating income 286 million, which is 13% of their revenue. That means they convert 13% of their revenue into operating income. Last year was 11.5%. Net income 351 million. Net profit margin 16%. Last year 10%. So everything's looking pretty good so far. Let's look at shares outstanding. Last year 350 million. Now it's 355 million. So they added a little less than 5 million shares when you compare last year to this year. Not too bad. You do want to see shares go down. But as long as net income per share is going up, that's the important thing. And it is. It's 99 cents per share. Last year, 56 cents. Let's look at a balance sheet. Current assets, 6.2 billion. Current liabilities, 7.4 billion. So they have a current ratio below 1. So they may need to add debt to get through the next 12 months. They have 3.4 billion of cash or marketable securities. 1.1 billion of accounts receivables. This is when they sell on credit. So that's money owed to them from their customers. Their biggest asset is long-term investments, 4.1 billion. They do give a breakdown of the 4.1 billion. 3.1 billion is corporate debt and 1 billion asset-backed securities. Asset-backed security is debt that's backed by an asset, such as a mortgage loan or auto loan. They also have a good amount of goodwill, almost 4.1 billion. They have 14 billion of liabilities, 5.5 billion of deferred revenue. So this means they receive cash for their service, but they haven't provided the service yet. When they do provide the service, then they'll book the revenue and remove the liability. So they have 5.5 billion of current deferred revenue and long-term deferred revenue, so over 11 billion. Assets minus liabilities equals equity, 5.9 billion of equity. They raised 4.2 billion from selling stock, and they profited 1.7 billion from running their business. Let's look at a statement of cash flows. The first section is operating cash flow, and that was 1.5 billion for the quarter, same as last year. The reason it was so much is because they had a cash inflow of 1.5 billion from accounts receivables. This means they sold on credit in the past and got paid this quarter. So if you look in previous quarters, you would see a big negative for accounts receivables in the operating cash flow section. In the investing section, they had a cash outflow of 540 million. 500 million from business acquisitions, and they talk about it right here. In August, they acquired IBM QRadar, and they expect this acquisition to accelerate their Cortex business. The total purchase price was 1.1 billion. They used $500 million of cash, and it looks like they used 649 million of debt. It was a contingent consideration liability. So this means they have to pay IBM 649 million in the future if something happens. It's contingent on something happening, like for sales to be at a certain level. Let's go back to the statement of cash flows. In the investing section, they also spent 44 million in CapEx. In the financing section, they paid back 319 million of convertible notes. They received 121 million from their employees in equity incentive plans. Let's look at a company on Simply Wall Street. Its last price, 390, 128 billion market cap. Down 1% in the past week, up 28% in the past year. It looks like the stock started trading in 2012 at $18, and it pretty much only went up. There were some dips here and there, but if you held on for at least a year, you should have made money. Simply Wall Street's valuation is $450. They say the stock is 14% undervalued. 49 analysts priced this stock at $411. They say it's slightly undervalued. Here's their revenue since 2014. It was 480 million. And it goes up every single year. It hit $1 billion in 2015, $2 billion in 2018, $3 billion in 2019, $4 billion in 2021, $5 billion 1 year later, $6 billion 1 year later, $7 billion the same year in 2023. Now it's over $8 billion currently. The CEO's salary is all over the place, from 150K to 1 million, down to 250K, back up to 1 million. Total compensation, 58 million. That's a big compensation. Tenure as CEO, 6.5 years. In the past year, there's been mostly insider selling, one small buy. 78% of the company is owned by institutions, 21% by the general public, and 1% by insiders. The biggest shareholder is Vanguard, then BlackRock. You have Geode, UBS, JP Morgan, Northern Trust, Clearbridge Investments, BNY, and Wells Fargo on the bottom. Their employee count has gone up a lot from 1,400 in 2014 to 15,000 currently. And the ticker trades on the Nasdaq, Deutsche Börse, Zicha, London Stock Exchange, Mexican Bolsa, Wiener Börse, Lima Bolsa, Borsa Italiana, Sao Paulo Bolsa, the Buenos Aires Stock Exchange, and the NEO. So if you want to learn how to build a discounted cash flow model, and I'll send you one for free, watch the video in the top right corner. Thanks for watching.